Offers bungee jumping for those looking for an extreme activity. JJ prepares annual financial statements and has a December 31st year end. On April 1st, JJ took out a 5-year, $500,000 bank loan with an interest rate of 3%. Interest expense is paid on the first day of each month. So the initial transaction, what would have happened when they took out the $500,000 bank loan? What would we have done? The initial transaction on April 1st, what would our transaction have been?
Debit the cash.
We would have debited cash and credited
Bank loan.
notes payable. That's right. Bank loan, notes payable. So now we need to expense our interest. Now the interest expense is paid on the first day of each month. So when the cash comes through on our bank statement, so an accountant's going to go ahead and they're going to, if they see something on their bank statement, they are going to put in a journal entry for it. Part of their monthly routine is reconciling their bank accounts. So we're going to get to that. But because we know that it's been paid on the first day of each month for the previous month's interest, we don't need to expense all of the interest from April 1st to December 31st because every month they've been paying it. If they hadn't, if it was an annual payment, we would need to expense everything from April 1st to December 31st because they haven't paid it yet, but it's still been accrued. But for this one, we are only worrying about 1 month of interest. So we can grab our calculators. And 500,000 times 3% equals 15,000. And that is the annual interest rate. So when you see an interest rate of 3%, you learn this in finance, the interest rate stated is always annual. So we only want the monthly, so what can we do with our 15,000? Divided by 12. And we get 1250. So we've got 500,000 multiplied by 3% equals 15,000 divided by 12. So on December 31st, actually we'll go back to, we'll take this slow and do it with our regular accounting analysis for each transaction. Which accounts are being affected here? Do we ever use cash in? No, we don't. So we have interest expense. That's right. Is it going up or down?
Up.
And what makes expenses go up?
Debit.
Okay, so we know what we're going to debit. And what are we going to credit? Right here, accounts payable. It won't be notes payable, so the note will always be worth this. Interest accrued. It would be similar to accounts payable. It's something that we owe. We're going to have to pay it the next day. But what we're going to use is an account called interest payable. If you put this in accounts payable, I probably wouldn't mark you down for it. But for this, we can put it in interest payable. So is interest payable going up or down?
Up.
And what type of account is it? A payable? It's a liability. So what makes liabilities go up?
Credit.
There we go. So interest payable. It's for $12.50. On July 1st, JJ issued a 2-year 50,000 note receivable with an interest rate of 4%. Interest income will be collected on January 1st and July 1st of each year. So, this is December 31st. We need to determine the interest payable. So what is our note? It's 50,000. And what's the interest rate? 4%. So that would be $2,000 per year. Now, it's collected biannually. So every 6 months. So it's been 6 months, it'll be collected the next day, but our year end is the 31st, so we can't wait till the next day to post it, so we need to do an adjustment. So we're going to multiply that by 6 over 12, right? It's the same as dividing it by 12 months and then multiplying it by 6. And we get a $1,000 amount owed. So, what accounts are going to be affected during this? Is notes receivable being affected? No. What is happening here? We are interest receivable, which is what? What type of? It's an asset, and it's going up or down. So we would debit it, right?
Yeah.
What are we going to credit?
Interest income.
Interest what?
Income.
Yeah.
Revenue. Interest is income.
Yeah, I'd accept both interest income or interest revenue. Is that going up or down?
Up.
And what type of account is it?
It's a loan.
So revenue.
Equity. Revenue.
So revenue. So what makes revenues go up?
Credit.
There we go. Interest. On December 15th, 2017, JJ took a university student club bungee jumping for $2,000. The student club was invoiced on December 31st, and JJ pays JJ Co on January 15th. So, on December 15th, so on December 31st, we're doing our entry for revenue. So have we done the work?
Yeah.
Oh, yes. Have they paid us?
No.
No. Okay, so which accounts are being affected?
Account receivable and revenue.
Revenue.
Is accounts receivable going up?
Yes.
Yeah.
Is revenue going down?
Yeah. No up.
Yeah, quick question. How do you make debits go up?
Yeah. It's debit.
Debit.
Or pardon me, assets go up? And revenue?
It's credit.
So we have accounts receivable, revenue for 2,000.